Hi, everyone. This is Eliza Berry from Richey May, and I just wanted to say thank you for joining for the attendees that are already signed in, and for those who are viewing this webinar sometimes in the future via the recording. Today, we are going to be offering CPE credit for this webinar. So we have our first disclaimer that this information is timely and related to tax regulations and is current as of the presentation time. Of course, if you have any questions related to changes, be sure to reach out to any of us on this webinar or at info@richeymay.com. Alex, yeah, cool. So we have CPE certification for CPAs who qualify under the NASBA rules. If you're unsure if that describes you, go ahead and answer the poll questions today and just verify that you qualify under the link that is in the invitation for this webinar. I will be launching poll questions. There will be 3 poll questions throughout this webinar. They are to gauge that you are engaged and attentive during the webinar, so they're not to test your knowledge. Make sure to answer those as they pop up. Now into the real meat. So today we're going to be talking about navigating the R&D tax credit as it relates to internal use software. If you have any questions, feel free to drop those in the chat or the questions panel, and I will help you get connected with someone on the line that can answer your question. And at the end, we will send out your CPE certificates, a link to the recording of this webinar, and the presentation slides so that you can reference them later. I'd like to introduce Kenny Birch, who is our tax manager here at Richey May, and he's going to talk to you a little bit more about the topic and SourceHOV Tax, who are our partners in this presentation. Take it away, Kenny.
Thank you, Eliza. As Eliza mentioned, my name is Kenny Birch, and I am a tax manager here at Richey May. We're really excited to have Dave and Alex from SourceHOV with us today to discuss R&D tax credits. This is an area that many of our independent mortgage banking clients have realized, great tax savings, and our hope is just to further educate our client base on these opportunities so that they can work with us to implement a tax strategy that is, optimal for our clients, as well as maximize their benefits and tax savings. So a little background on SourceHOV. SourceHOV helps CPA firms and their clients maximize, kind of specialized federal and state tax incentives. Well, R&D credits are going to be the focus of our conversation today, but they also do offer a variety of other services that include things like cost segregation studies or Section 179D, sustainability deductions. So, many of our clients have worked with SourceHOV in the past, and they've provided really great feedback to us. We think they're a great company, and we think they do great work. A lot of that feedback, includes their expertise on the topic, their ease of, really translating that into layman terms and making it easy for everyone to understand that's not necessarily an expert in that field. And really just the ease of working with their team. People have really enjoyed their experience with SourceHOV. With that said, I'm going to provide a brief introduction on Alex Pack and Dave Finley, as they're going to be our speakers today, and then I'll turn it over to Alex. So, Alex is a director in the Research and Development Tax Credit Consulting Department for SourceHOV Tax. Alex is primarily responsible for conducting preliminary evaluations for R&D qualification and executing projects for a wide range of industries. Alex has 10 years of direct experience with R&D tax credits with regards to calculation, substantiation, and defense. Dave Finley is a director of business development for SourceHOV Tax in the Midwest region. He acts as a liaison between CPA firms, their clients, and SourceHOV, and presents opportunities in coordination with their technical directors. Dave's a CPA with 30+ years serving clients in a tax capacity, the last 18 years in the area of tax credits and incentives. Dave graduated from San Diego State University in 1985, and prior to working with SourceHOV, was a senior manager in Deloitte's tax practice. Again, as I mentioned, we're really excited to have them. If you'd like some more information on Dave and Alex, You can find their bios at the back of the slide deck once that is distributed. And with that, I will turn it over to Alex and let him get started with the presentation.
All right, everybody. Thank you so much for joining us. We really appreciate it. We know Q1 is a very busy time, so we'll try to keep this as entertaining and as painless as possible. In terms of an agenda today, we're going to be going through the history of the R&D credit, so you guys have a little bit of background on how it came to be, what the motivation was, and ultimately what it looks like today. Then the overview of the credit itself, that includes how we qualify projects, what sort of expenses qualify, and then ultimately how we generate the credit itself. Then we'll talk a little bit about qualifying industries and activities, then the audit environment, what auditors are actually auditing, and then what a typical R&D tax credit study looks like. If you guys have any questions, I believe the chat is open and Eliza will be moderating for us on that front. But barring that, we'll go ahead and get started. So the R&D tax credit was actually enacted back during the Reagan administration in 1981 because of a big problem that the US was facing. And there's the actual term of art that was developed for that, and it was called brain drain. And basically, during this time, a lot of manufacturing, a lot of engineering was starting to move overseas. And the US wanted to incentivize companies to keep that type of activity here. In its earliest iteration, the credit was actually very limited. It only allowed companies to take credit for true innovations within the industry in which they were operating in, and basically you had to be leading the industry, meaning that you had to be the first to develop a product or process in order to qualify for the credit. An example that I always use is, let's say we were talking about Palms. I don't know how old everyone is in the meeting, but Palm Pilots were the original smartphones, I guess, and with this version of the credit, the initial version, basically every other company that developed some sort of Palm handheld smart device would not qualify because they wouldn't have been creating a new discovery within their industry. Since then, in 2003, the criteria for the discovery test and the leading industry test were all removed. And now we have the modern version of the R&D tax credit, which is much more expansive. It doesn't look at discoveries with regard to their place within the industry, more within their place in the company's history. So if it's something new to you, that means that it's going to qualify. Now we'll get into that in a little bit. In addition to that, there were many, many taxpayer favorable changes that were made since 2003 that actually broadened the scope of the included expenses, in addition to how the credit was audited. So a lot of changes have happened over the last 17 years. And even in the most recent tax extender, the TCJA, there were some really important changes that allowed for better utilization. So we'll be reviewing all of that today. So everything with regard to the R&D tax credit starts with this four-part test. The four-part test is how we determine whether or not a project is R&D qualified. And by its nature, the R&D tax credit is a project-based credit. What that means is you take a look at the breadth of all the projects that a particular company has been working on for a particular tax year. And for each one of those projects, you have to go through this four-part test to determine whether or not that project qualifies. And then ultimately, once we can answer that question, we can start looking at the expenses associated with each one of those projects. Now, in order to qualify an R&D tax credit project, we need to be able to answer yes to each one of these questions, and I will go over each one of them now. So at the top left quadrant, we have permitted purpose. That's really saying that if we're developing something new, whether that's a product or process, or making improvements to a currently existing product or process with regard to functionality, performance, reliability, and quality, That answers the first question. So that is a really, really easy test for us to overcome, because obviously every time you guys are working on something, you guys are trying to either improve it or create something from scratch. So that's one of the easy questions to answer. The next, probably equally as easy, is technological in nature. Just means that the activity that we're doing within the project is based in hard science. So a really good example of that might be, let's say we're developing a new web platform, and we have an artist that's basically doing all of the graphics for it. Now, that is an aesthetic concern which isn't based in hard science. But if we take it a step further and say, hey, how do we implement the elements of this user interface into our platform, and how do we code up all of the processes that basically feed into the interface and then offer the functionality that users are really looking for? Then that first part, which would be art-based, would not qualify. But then that second part, if we're looking at a big picture view, when we start actually doing the coding and engineering, would qualify with regard to being technological in nature. Obviously, there are different degrees of qualification when it comes to being technological in nature, and we'll explore that when we start getting to the types of expenses that qualify. But there are some activities that we know to be precursors to actual core development, and in most cases we could qualify those types of activities also. So with regard to, let's say, a graphic designer, we may not be able to take all of the aesthetic elements that individual graphic designer was working on, because a lot of it is just going to be beautification, right? But when we start talking about planning, doing wireframes, coming up with workflows, coming up with ways functionality is delivered on the platform, all of a sudden that is a technological activity that we can capture. So there is a little bit of nuance to each one of these areas. The bottom two quadrants, the first being elimination of uncertainty, and then the second being process of experimentation, go hand in hand. The elimination of uncertainty speaks to a technical uncertainty that exists at the beginning of a project. So that is not a business concern, but a technical concern that requires some sort of process to come up with alternative solutions or a solution to that problem. This uncertainty has to be technical and can concern capability, meaning is our company capable of actually delivering on this type of project? Method, how do we get from point A to point B where we have an acceptable product for our client or our user base? Or appropriateness of design. So once we identify that there is a real technical uncertainty within that project, we could start looking at the last test, which is process of experimentation. Usually when we talk about these technical uncertainties, they're going to be the items that you all are talking about with your internal teams when you guys start a development project. What are our goals? What sort of functionality do we want to bring to the platform? What sort of requirements do our clients and our user base have? All of these types of questions that ultimately are developed into like user stories. If you guys are practicing agile development, that's what speaks to that technical uncertainty. The last test here at the bottom right quadrant is the process of experimentation. And usually when I say experimentation, a lot of people are thinking white coats in a lab, and that's definitely true. But the tax definition of what the IRS considers to be experimentation is much, much broader. It's basically everything that you have to do that's technical, that solves the uncertainties that were laid out at the beginning of the project. So with regard to development of a platform, that could be everything from having ongoing status meetings where you guys are discussing technical challenges, having pre-conceptual design meetings where you guys might be just talking about workflow, having meetings for planning purposes where you guys might not be working on a specific part of the platform, but evaluating technologies and functionality that you may want to integrate in the future. All of these things, in addition to activities like code review, quality review, validation, testing, all of those speak to a process of experimentation that will be accepted by the IRS with regard to your R&D project. So once we can answer all of these questions and say, yes, check, we have that element within our project, that project will then be R&D qualified, and then we can start looking at the associated expenses that surround that project. So if you travel with me to the next slide, this is where the rubber meets the road, so to speak. So once we actually qualify a project for the R&D tax credit, we can start looking at these 4 different pools of expenses. Usually, in 99% of our clients, the biggest pool of expenses is the salaries and wages pool. At a very high level, basically what this analysis entails is looking at each employee's annual contribution in time on a qualifying R&D project. So let's say we have 10 projects that we've qualified for the R&D effort, and one of my main software engineers spends 90% of his or her year on this type of development. Then at a very high level, I would be able to qualify up to 90% of their W-2 Box 1 wages and throw it into this salaries and wages pool. Now, the IRS understands that there's a core group of development folks that basically work the bulk of their time on development issues. But in addition to that, a business has to have other personnel surrounding that core group to support their effort. So what they allow us to do is actually not only qualify that core individual that's driving development, but also folks 1 level above in terms of direct supervision and 1 level below in terms of direct support. So let me give you a hypothetical to kind of show you what that looks like. So let's say I am one of your engineers, and I spend nearly 100% of my time doing coding up both front-end, back-end issues. I'm a full stack developer. And let's say I have an intern that works for me that doesn't necessarily make decisions on where we want to take the development and how we want to get there, but really just executes all of the tasks that I assign him or her on any given day. Now, as long as those activities are still technical in nature and they go to support the direct research and development that core individual is performing, then we could qualify a portion of their time as well. In addition to that, we could also look at the supervisory levels within the company. So depending on how your company is structured, let's say you guys have C-level executives along with VPs and directors that sit in a meeting that both do planning and direct management of the actual project, then we would be able to qualify their time as well. Most of the time when we get into larger size entities that do have C-level executive management, what we tend to see is that those C-level executives are usually pretty involved in the development at their company. We've seen CEOs qualify at a very high percentage, and CTOs, CISOs, a lot of these C-level titles that are related to technical development, we tend to see qualifying at a pretty high clip. That being said, even a C-level executive or a VP or any level executive or middle management type of individual that does participate in this type of development effort, we would be able to qualify even at a small percentage. So that analysis is done for every single employee in the company. And you're going to have some folks that qualify at 0% because they're not driving development or participating in the technical activities, and then folks that fall on the other end of the spectrum that are highly qualified. The next pool of expenses are supply costs, and usually with regard to mortgage banking, we do not see any sort of supplies costs being qualified, but anytime we're developing a tangible product at the end of the day, if there are prototypes being made or samples for validation, we could actually qualify that effort. But like I said, in the mortgage banking industry, we usually do not see these types of expenses. The next pool, actually, we tend to see much more, and that's the rental or lease cost of computers. Now, with the advent of the internet and cloud computing, the costs that we actually qualify in this category are developmental costs associated with things like test environments, test servers, and validation efforts on the cloud side. Now, if you guys have infrastructure that you guys already purchased and keep as an asset where you guys have locally managed servers, this pool would not apply. But if you guys use services like Azure, AWS, or any number of cloud computing platforms to deploy your platform across the internet, then we would be able to qualify a percentage of those costs with regard to the actual development environments that are set up. The last category is actually pretty interesting, and that's contract research, or sometimes called contractor costs. Basically, if we hire someone outside of our company, whether that's via 1099 or an outside firm that basically invoices us for development that we want them to do, we're able to qualify up to 65% of those costs for the credit itself. Now, all of these costs from all four pools get aggregated together and then ultimately get fed to two different R&D calculation methods. The first is called the regular method, which basically looks at what percentage of your gross receipts you're spending on R&D historically, and then uses that percentage to create a base in the current year. Every dollar that we exceed of that base, we actually get a 20% reward on in terms of tax credit. The second method is called the alternative simplified credit, and this is mostly used for either companies that don't have historic data available or have had a fact pattern that maximizes alternative simplified credit generation in the current year, meaning that there was a spike in research expenses in the current year and the prior years are much lower. In this case, the base is actually the average of the prior 3 years reduced by 50%. And for every dollar we exceed of that base, we're generating a 14% return on. At the end of the day, both of the credits kind of fall within the same range, barring any fact patterns that lean one way or the other in terms of credit optimization. But you're looking at anywhere between about 5.5% to 7.5% in return for all the expenses that are aggregated across these four pools. All right, so let's go ahead and start talking about mortgage banking specifically. Some of the qualifying activities that we've seen in our studies with the mortgage banking industry, obviously the low-hanging fruit would be things like LOS system development, database development, process automation, all really huge things in the mortgage industry, because obviously there's a lot of compliance that needs to be done on both ends, both on the client end and on the originator end. In addition to that, what we've seen in the current landscape is that there's a lot of third-party services out there that basically bring functionality and technology that sometimes companies want to leverage within their systems, and even that type of API integration and third-party integration would actually qualify insofar as development costs. So what I want to do is talk a little bit about a case study we had from last year. Basically, a national mortgage company with presence in most of the US wanted to look at an R&D tax credit, and they had never claimed the credit before. So during this development, we found that the company had about 3,000 employees, but only 40 of them were actually participating in the development. That included C-level executives, VPs, directors, and obviously the developers and product managers that are actually in the weeds, the boots on the ground, doing the development day to day. And in addition to that, the quality teams. Basically, the way that it worked was the C-level executives, with the exception of the CTO, were basically qualifying time for all of the planning that they did surrounding the platform, in addition to evaluating functionality, evaluating development path, and determining what direction they would like to go with that platform. The directors and the VPs were had more involvement on a day-to-day level, and sometimes, in some cases, even did some coding themselves. Obviously, the developers and product managers were definitely the ones driving development with regard to actually executing those development tickets and ultimately bringing a proof of concept or some sort of first run at the platform level. And then to round it all out, we had the folks that were testing the various parts of the platform qualified for the credit as well. So in this case, across tax years 2015 through 2018, the company generated roughly about $490,000 in gross credit from those 40 employees that were working on their platform during that time. And because all of the employees were located in a state with an R&D tax credit, in this case, Texas, they were also able to generate roughly about $170,000 state credit. Now, obviously, every single state does not have an R&D credit. There are states that have very lucrative R&D credits. A couple of states that come to mind might be Texas, Utah, California. Colorado also has a credit, but it is limited to folks inside enterprise zones, and that's something that you're going to see on a pretty broad scale across the US. So states have the right to have their own requirements within their state tax credit program. So that's going to vary from state to state. All right, so here's where we start helping you guys out a little bit after providing the background of where the credit is and what the potential opportunity is for credit generation. One of the things that Kenny wanted us to talk about were some best practices that you guys could implement currently that'll put you in position to actually generate a pretty sizable benefit, so that when you guys are ready to actually move forward with some sort of R&D tax credit study, you guys are already set up and kind of know where the landmines are. The first thing that we see often is outside development. So anytime that we hire someone that isn't part of our company, and whether we pay a 1099 or pay an invoice that's issued by an outside entity, there are some issues that we need to make sure that lean one way or the other. So the first and most important piece is that we need to be charged by this outside entity or individual on an hourly engagement. So what that means is, let's say we have a developer that's doing a module for one of our LOS system, and this developer says, hey, I could build this module for you, but I'm going to charge you a fixed fee of $20,000. Now, even though the risk is really with you, the IRS sees this as the risk being on the performer of the work because it is a fixed fee situation. Their logic is, if it's a fixed fee and the performer of the work takes more time than they initially estimated, then actually the additional development comes out of the performer's dime, meaning that they're gonna keep on working in order to get that order fulfilled or get that scope of work completed, even if they exceed what their initial estimate in time investment might be. Now, in that same situation, if that contractor said, I'm going to charge you $300 an hour, and I think it's going to take 1,000 hours to do this development, then the IRS sees that as the risk being on the purchaser of that work or the person that commissioned it. So a really easy way to remember is fixed fee, no good when it comes to outside development. Hourly charges are good when it comes to outside development. And this also includes contract types where there's just an hourly retainer billed on a monthly basis with excess hours being charged on the back end. We see that as an hourly engagement as well. And one of the things that you want a consultant to do is not only look at how companies are charging, but also review those agreements so that we make sure that it's going to qualify with regard to the Internal Revenue Code or the IRC. The second thing that comes up a lot is that a lot of times there's companies that outsource development to other countries where labor might be cheaper, or they might have the skill set that really fits well with the type of work that's being performed. Unfortunately, any foreign-based domestic costs we cannot qualify. The only exception to this rule is when a foreign entity sends personnel to the United States to work in conjunction with the client that's US based. So a really good example that happens a lot is, let's say we hire a US based development firm and they have an arm in the Ukraine or in India. Now this company is going to be performing performing on the scope of work with both US based and foreign based employees. In this situation, as long as those costs are hourly, we can actually qualify the domestic portion, but we would disqualify the foreign portion. So that is really based on what sort of personnel you have working in the US versus what sort of personnel or what sort of work is farmed out to that foreign development arm. Next thing is contemporaneous documentation. One of the things that really worries a lot of folks is audit, and that's probably the right call, since the audit is the really the only way that the government actually reviews these claims. And in audits, it's really important to maintain documentation across all of the projects that are being qualified. A lot of this is gonna, when it comes to code development or the development of software, it's cataloging the code, taking developmental notes, taking engineering notes, adding notes to Agile project tracking tool tickets so that technical challenges are outlined, and then solutions or options for solutions are also outlined so that you can document and show contemporaneous documentation that has been developed with regard to the development taking place. Other simple things that you could put into place might be taking meeting minutes and Scrum minutes, and obviously tracking developmental cloud computing costs, which is another area that record keeping kind of suffers. The next thing that I want to talk about briefly are provider red flags. Obviously, there's going to be some people in this webinar that have already started working with outside consultants. Most of the time, what we tend to see is that people stick with consultants for years and years, mainly because it's really difficult to teach someone every year about the business, how everything works, what sort of activities were qualified previously, and how to go about actually executing that study. So what we tend to see in this industry a lot is folks that have stayed with the same consultant without understanding how the market has changed over the years that they've been a client. So they're not actually sure about what the norm is when it comes to how folks charge, how they handle audit, and how they actually execute the study. So contingent fees, that's a big thing. If you have an engagement where someone's charging you, the language is usually not to exceed some sort of percentage of your benefit, that's considered a contingent fee and actually frowned upon by the IRS. The reason being is that it improperly incentivizes the consultant to be aggressive in credit generation because that directly translates to bigger fees on their end. The next is audit support. This is a really, really big issue because some of these R&D audits tend to take a long time, not only because, obviously the credit itself is complex, but because this is one of the biggest tax credits for folks that do development in the United States. And because of that, there's a lot of scrutiny because at the end of the day, if it was a deduction, the tax impact might not be as big, but since it's a tax credit and a dollar for dollar reduction of actual tax liability, that starts being an issue and there's a little bit more scrutiny when it comes to these reviews. In addition, one of the other complaints that we constantly hear from clients is that they were with a provider where every single year there was an entirely new team, or they had multiple points of contact dealing with the same study on an annual basis. And this is definitely not good because every single time personnel changes happen, that transition between your old team and that new team means that there's a chance that things could slip through the cracks. The last thing that we actually come across a lot with regard to personnel is just the lack of experience. Usually in a sales setting, you'll have director level folks or partners that are sitting with you, walking through the estimate, telling you, hey, this is what we think you're going to generate. But once you're engaged, they send out folks that have 1 to 3 years of experience to do interviews and actually work on the calculation. That's a really huge problem because obviously the credit itself is extremely vast. It affects a lot of different industries. So it's really hard for folks that don't have a lot of experience to know all the ins and outs and the nuances of how those credits work, and more importantly, how to defend them. The last thing that we've heard surprisingly often is untimely or non-delivery of the technical report. So usually an engagement is split into 2 phases. The first phase being the actual analysis and the calculation. The second phase being the documentation, which usually it's our industry standard to actually issue a report that basically outlines how we generated the credit, what sort of expenses qualified, what projects qualified, and then ultimately write memos about each one of the projects that were qualified that frames it within that 4-part test discussion. A lot of times when you've been working with the contractor for a long time, they tend to push the deadline for delivery of this report. And we've even heard of situations where a client stopped getting reports for a couple of years. And when they ask for it, they say that they'll roll it up into the next year's study. This is definitely not acceptable practice in this day and age with regard to where our industry has come and the amount of audit pressure that has slowly been growing over the last 6 to 7 years. All right. I think we have a poll question here, right here. Liza, do we have that set up?
Yes, I am going to go ahead and launch the question now. And just in case I didn't mention this at the beginning, you do need to take all 3 polls in order to qualify for the CPE credit. So go ahead and answer that poll. And once we get a decent amount of answers, we'll move on to the next question, or the next part of the presentation, I mean.
Okay, sounds great. We'll give everybody a minute to fill those in, and Eliza, let me know when we're ready to move.
Okay, going to give about 10 more seconds here, and then I will close the poll. All right, thank you very much.
All right, for this next part of the presentation, I'm going to turn it over to David Finley, who is a CPA and will answer any questions about credit usability. David?
Thanks, Alex, and thank you folks for being with us today. Appreciate that. So talking about credit usability, big key question is, even if you can generate a credit, can you actually use it? And although there are some state R&D credits that are refundable, the federal R&D tax credit is not refundable. So the bottom line is you need to be in a tax-paying position to utilize it. If you are not, the good news is you can carry it back a year and get a refund for past taxes or forward 20. So it's got quite a long tail going forwards to utilize anything you generate. And we'll talk about why for the mortgage banking industry, you'd like to accumulate credits now, given certain things, but we'll get into that in a minute. And then know that you can, in general, carry credits back, or not carry credits back, but rather do studies to amend the prior 3 years. So those are the open tax years. You can get do refund studies back 3 years typically. You can go back even further into closed years. If you happen to not be in income in those closed years, you can carry credits out of there into the future. But generally speaking, it's a 3-year statute of limitations. So you've got 3 years to claim refund for the past. So another thing about the R&D credit is it is a general business credit. And the big thing about that is that the general business credit does not reduce alternative minimum tax. Now, the good news is for all you guys who are with C corporations, is, as you know, AMT is no longer an issue for C corps. It's been eliminated with the most recent Tax Act. But for flow-through entities, and specifically the owners of those flow-through entities, they still are potentially subject to AMT. So when credits flow through to individual owners, we need to be mindful of their tax position. Are they in AMT or not? Good news is with the last Tax Act, and we'll talk about this in a minute, far fewer people, individuals, should find themselves in alternative minimum tax. So let's flip to the first of the two most recent tax acts, the PATH Act, which is, I'll talk jokingly about each one being a gift from the then president. This was a gift under the Obama administration. It was came about in January of 16, and in a nutshell, the PATH Act did 3 main things. It made the credit permanent. Previously, it would expire every 2-3 years and need to be reinstated, and there was always a tremendous lobbying effort to do that, and periods of uncertainty until it got reinstated. So it's now permanent, which is a good thing. It provided AMT relief for qualifying smaller businesses or the owners of those businesses if it was a pass-through entity. And then lastly, it allows qualifying startups who would otherwise not care about the credit. Startups are typically in NOLs or losses. They don't care. They're not in a tax-paying position, so why would they want to create credits? And it allows them to use it against their payroll taxes. So let's talk about the latter 2 things there, the qualifying small businesses and usage against AMT. So if you're a qualified small business, and by the way, so since C Corps no longer pay AMT, this really is, the applicability of this is to the flow-through entities, your S Corps, partnerships, LLCs. So the extent that you are a qualifying small business, and that would be a business that has average gross receipts the past 3 years of 50 million or less, you are allowed to use the credits to offset your owner's AMT freely. The next thing it did was to, with respect to the payroll tax credit, if you're a qualified startup, you can utilize the credits to offset payroll taxes. And a qualified startup would be, these are very small businesses. They're businesses that are in their first 5 years of gross receipts history and that have $5 million or less of gross receipts in a given year that they're going to generate this type of a credit. Now, it's important to note that even small amounts of income can actually count as an income year. So if you're in your first year and you've got some interest income, that counts as far as it being an income year. So you need to be in your first 5 years of gross receipts history, and you need to do it on an originally filed return. You couldn't in year 8 decide to go back and amend to claim this kind of a credit. So you want to strike, if you happen to be a startup, you want to strike while the iron's hot, get these credits on the boards. You can still use them, even though after 5 years you can't create new payroll tax offsetting credits. You can use them into the future against payroll taxes up to the 20-year carry forward. The way it gets utilized is it gets used in the first payroll tax quarter prospectively that once you file your return. So a 2019 return that's filed on March 15th of this year, you'll start using those credits in the second quarter against payroll taxes. Let's flip a slide. So TCJA, that was the Trump administration gift to you. That is effective January of 18 for most of the provisions of that. And the thing about it, while it did nothing to really change what qualifies for the credit or how credits are computed, it significantly enhanced the potential utilization of the credits themselves by all types of entities. It really opened that up. Before we talk about that, let's just talk about what it did to NOLs, because this has is of particular interest to mortgage banking companies, firms, in that what we've noticed is that the income patterns of mortgage banking companies tends to be cyclical with the changes in interest rates and whatnot. They'll have periods of NOLs and then big income events. Well, the Tax Act, what it did was to say that any NOLs that are created, any losses that are created in 2018 and forward, no matter how big they are, when you go to use them, they can only offset in a given year 80% of that year's taxable income. So you're always going to be, even if you have NOL carryforwards, you're always going to still be subject to tax on 20% of the remainder, right, of income. So what can get you most of the rest of the way is R&D credits, and you're going to want to have those in your back pocket for when you have your income, your big income events, for perhaps a sale of a mortgage portfolio, that kind of thing. As far as opening up utilization, then we talked about that, C corps aren't paying AMT anymore, so that's not an issue at all. So the only remaining limitation on C corps using the credits is just the general business credit limitations, and those are pretty generous. And that is that you can use the credits to offset the first $25,000 of tax and 75% of anything in excess of that. And just for simplicity's sake in your mind, if you just think I can offset 75% of my tax with R&D credits, that's kind of a shortcut. So you can really go a long way to eliminating most of the rest of the tax that maybe your NOL carry forwards won't do for you now. That's for C corps. Now, individuals weren't quite as lucky. They're still subject to AMT, but with the changes in the Act, far fewer individuals should be subject to AMT, and that's for two reasons. The exemption, in other words, how much income you need to be exceeding before you're even subject to AMT, that increased. For married filing jointly, it's about 110,000. And the phase out of that increased from about 160,000 to $1 million. So you don't even phase out on that till you get over $1 million of taxable income. And so more people are getting the benefit of that exemption. So fewer people are in AMT. The other thing that helps keep people out of AMT with the new Tax Act is that cap on the state tax deduction. And so that's it's state taxes are an add back for AMT. And now they're capped at 10,000. That's cap 2. So far fewer individuals are finding themselves in AMT, meaning that far more people can actually utilize the R&D credit. Flip the slide, please. So let's talk about one other big ticket item with the TCJA. What it did is this 280C election. Now we haven't talked about that yet, but I'll give you some background. To take, and this works this way with all tax credits basically, is to take a tax credit, which is, as Alex pointed out, a dollar for dollar reduction in tax. You typically add back the deduction, and that's worth whatever the deduction is times the tax rate. So when the C corp rate is 35%, you typically, to gain $1 of tax reduction, you give back 35% or 35 cents of deduction. So within the R&D credit rules, there is an election that can be made that actually simplifies that process and avoids unintended results. Doing that add back can sometimes cause people to be in AMT and whatnot, and it's just it's cleaner if you can simplify that and just take a net credit, and that's what this election does. The 280C election just allows you to haircut your credit, so to speak, by what the tax effect would be, and really you get to the same end place, but it's far simpler and it avoids any unintended consequences. Now, the important thing is to note is that you cannot amend a return to do that election. So it needs to be done on an originally filed return. And there's something that it's very easy to do a protective election, and Richey May would clearly do this for you if it's thought that you would potentially want to take the credit in the future. But is to put a protective election in the return. It's as simple as heading up the form and checking the box. The rest can be blank, but just head up the form, check the 280C election box, and you're good. In the future, if you ever want to come back to this year and amend them and claim the credits, you've got a valid election in place to do so. So I would recommend that, even if you remotely think in the future you might be coming back to this year to take a credit.
Hey, Dave, do you mind if I interrupt for just a second to do the poll question? It looks like we might run a little bit over time, and I just want to make sure that people can still receive credit.
Yes.
Okay, cool. So I'm going to go ahead and launch the second poll question. So go ahead and answer that in your browser, and I'll give you about a minute to go ahead and fill in your answer. Great, I'll give you about 10 more seconds just for those couple of people who answered the first question, but not the second one. You do need to answer all three to get the CPE credit. And just in case we do run over time, again, we'll be sending out a recording and the slides, and I'll be hanging out for a little bit after the webinar as well if you have some questions, and I'll make sure they get to the right person if you still just ask them in the chat, even after the webinar is over. All right, looks like we got all our answers, so I'm going to close the poll and take it away.
Sure. So the next page just graphically shows both before and after the last tax act what the value of this election was. And since the election references the highest corporate income tax rate, and it does so even if you're an individual and not subject to corporate rates, you still, if you make this election, you get this benefit. So before the corporate tax rate dropped from 35% down to 21%, it used to be that $100,000 of gross credit, you can see that on the left, netted you $65,000 of tax reduction. With the change in the corporate rate, when you make this election, it's now you walk with $79,000 of tax benefit, and so that's on the same amount of expenditures. The taxpayer did nothing different. It's just that after the Tax Act, it's actually doing the credit is worth more to them now. And it is important to note for an individual that if you don't make this election and you actually do manually, do the add back, you don't get the benefit of that corporate rate, which dropped quite a lot. It's a lot less than an individual rate. So the value of an individual doing it is far greater, and they don't want to miss out on that opportunity. Let's flip the slide. So what should you look for in a provider, even if it's not us? You want a provider to charge a fixed fee that's centered around project scope. Alex talked about the other type of fee arrangements out there, at least the contingent fee. There's also something out there, an hourly, not to exceed a cap. And you don't want either of these, the contingent fee because of what Alex pointed out in the audit scrutiny, but the hourly with the cap, that unfortunately doesn't incentivize good behavior either in terms of how they use your time. The cap is typically set at about 30 to 35% of what the estimated credits are, and in all of our experience, when clients come to us from other providers that charge this way, they always hit the cap. So it's a pricey proposition. You want a provider that's going to quote you a fee based on their assessment of the project scope and what it's going to take to properly document it and get it across the finish line. You want it to include audit support so that at a later time, you want that fixed fee to include that so that at a later time you're not paying hourly to defend the credits if necessary. And you'll find that if you have that type of a fee arrangement that is, fixed fee, true fixed fee based on scope, that it's going to be a much better usage of your time, because both it's all oriented towards efficient use of your time with a single point of contact, consistency in your team, your project manager and the team from year to year, so there's not a re-education of the people that are doing the work as to what your business and whatnot and how to work with you. You want a provider that's going to give you a no-cost upfront estimate that utilizes senior people to do that, not just a business development person, but a senior person. Like Alex is the one that works with me, and Alex comes with 10 years of direct experience on point. So you want that for a more realistic estimate. Another thing about that I'll just point out about Source is that we were the founders of the one of the founders of the National R&D Credit Roundtable, and that is a group of about 12, 13 firms that meet on a regular basis to discuss best practices in the industry, what's going on with the IRS, the new R&D Credit Audit Group, what they're looking at, how to design deliverables and whatnot that best speak to audits. And that's another thing, is that you want a comprehensive deliverable. It's always being fine-tuned to speak to the audit, and you want it created at the time of the engagement, not later, but you want it actually, everything that would need to be in that to support a future audit, you want done contemporaneously with the work that's done for a given year. And so that is a hallmark of how we go about what we do. We design, or actually accumulate, that deliverable for the audit right when we're doing the engagement. You want a client service model that's really focused on the long-term relationship, not overestimating the credit. You want a usability assessment up front. That's why we would include somebody with Alex's experience, so that they can address usability issues, corporate structure issues, alternative minimum tax issues, things of that nature. And also you would like that each year at the end of the engagement, there's an assessment of how the client might be able to fine-tune things to better capture expenses and increase the credit, things that make the engagement go better. And so you want that kind of a not same as last year approach. And lastly, you want an extensive team experience and track record. And I will say that we started out in about '83. And our team, the R&D team, collectively has about 230 years of experience. We do not hire entry-level people. Everybody comes that's working on our engagements and the project team are 5, 6 years and above. In fact, our rookie has 5 or 6 years, but most of the folks are north of that. And as far as track record and audit, 92% plus audit suspension level. So extreme amount of experience in that regard. And it looks like we're bumping up against the clock. So while we might go into a little bit on the audit, I think we probably want to open it up to questions at this time.
We actually can go ahead and just run that third poll question. So I'm going to go ahead and launch that. So make sure you answer that and go ahead and type any questions in the chat. And there we go. So Dave, we did have one question kind of earlier on in the webinar that you can speak to after I close the poll, and that is, does the person involved who is not developing have to be in the developer's chain of command?
The easiest answer to that question is no. We actually are comfortable with qualifying, let's say, a C-level executive that doesn't have direct control over the project team that's actually executing the work, as long as the participation by that C-level executive speaks to either current development or development in the future. So it is pretty broad when it comes to the types of activities that qualify, and as long as those qualifications aren't unreasonable, we will defend it.
Great, thanks for answering that. And I'm going to just give about 5 more seconds before I close the poll. I think we have collected all the responses of the people participating for CPE. So thank you for answering those.
We'll answer further questions now, but if people don't have a question now, but it comes up later, my contact info is in the back, and if I can't answer it directly, Alex certainly can, and we'll speak to anything you have in your mind. So please don't hesitate to reach out to us if future questions arise.
Lisa, to respond to your question, will you send out the webinar to attendees? Yes, we will send out the CPE certificates for those of you that participated within the next few weeks, but we will send out the slide deck and the video recording of this webinar out to all attendees that were registered. If you need me to send it out to someone who wasn't registered, or you want to forward it on after you receive it, that's cool too. If you want me to add them to the attendees, just send an email to info@richeymay.com. Ken asked, what period does a study cover and are repeat studies necessary?
Yeah, that's a great question. So the period, usually if it's a first time go, you've never worked on the credit before, it's all open years. So that means 3 years from the date of filing. So if we're looking at a company looking to do 2019 as their first year, we could actually go all the way back to 2016 to get credits that we left on the table back then that we didn't claim. So for all of those amended years where we do go back, you're entitled to refunds on taxes you've already paid. If those are lost years, you would just be creating carry forwards to carry forward. And that's basically how it works. In some states, there are states that have a longer statute of limitations. Like in California, you could actually go back 4 years from the date that you filed your return. So it does vary from state to state a little bit.
Great, thanks for that question, Ken. And as I said before, I will keep the webinar open for about another 10 minutes and make sure that your questions get to the speakers. But again, thank you for attending, and thank you to our partners over at SourceHOV for presenting with us, Alex and Dave, and of course, Kenny from Richey May. So as I said, I'll send out the links to the presentation soon, and thank you for attending.
Sounds great. And Dave and I will also stay for the next 10 minutes just to answer any questions that may come in.
Peter says, thank you for your collective insights. You are welcome, Peter. Thank you for attending.